I want to start today with a question that honestly is just staggering when you think about it.
Okay, let's hear it.
How does a company with just 7 employees,
7, that's the number. 7 full-time employees.
right, 7 employees, how do they achieve a market capitalization of $15.5 billion?
That is the investment question we are tackling today. It's this massive paradox at the very heart of the company, a company that pivoted from being a simple crypto miner to becoming the single largest corporate holder of Ethereum in the world.
It's an incredible story, and that discrepancy, the huge valuation versus the tiny operational size, really defines the risk here.
It defines everything, the risk, the reward, the entire thesis.
Welcome to DeepResearchGlobal.com podcast.
My goal today is to really break down Bitmine Immersion Technologies for you, the serious investor. The ticker is BMNR.
And we're going to structure this as a clear strategic overview. We'll look at the core financials, which are challenging, to say the least.
Very challenging. But we'll also look at the explosive potential that makes BMNR. I mean, it's one of the riskiest, but also one of the most fascinating plays in the entire digital asset space right now.
And I think understanding that dual nature is absolutely critical for your portfolio allocation. You have to see both sides of this coin.
Absolutely. You have to.
Okay, so let's start with the basics, the foundation of the company. Lay it out for us.
Well, the funny thing is, BMNR was actually founded way back in 1995.
95. That's ancient in tech years.
It is. But its current identity is, completely different. It's a blockchain technology company, industrial scale. They do digital asset mining, equipment sales, hosting operations, the whole package.
And it's a publicly held corporation, right?
Right.
Trading on the NYSE American.
That's right. And you might remember by its old name, which is far less exciting, Renewable Energy Solution Systems.
Doesn't have quite the same ring to it.
Not at all. So the key date we analyzed, September 23rd, 2025, the stock price was $54.49.
Which gets us to that $15.5 billion market cap based on about 285 million shares out.
Exactly. And now let's circle back to that paradox you mentioned, the 7 employees.
Yeah, I'm stuck on that. 7 people.
It's critical. This minimal operational footprint is absolutely key to understanding both sides. On one hand, you have massive efficiency. They don't have the overhead of a typical infrastructure giant.
But on the
other hand is immense execution risk. And we're going to dissect that. I mean, the central question is, how do 7 people manage a $15 billion entity with global infrastructure? That's what you're buying into.
Okay, so let's get into the core investment thesis. What is driving that massive valuation?
It's almost entirely built on one single colossal number, 3.5 million ETH tokens.
3.5 million.
3.5 million. I really have to emphasize the significance of this. Bitmine is now, without any question, the world's largest corporate Ethereum treasury company.
Can you put that into perspective for us? What does that number actually mean in the context of the entire network?
It's a massive slice of the pie. That 3.5 million ETH represents 2.9% of Ethereum's total circulating supply.
Almost 3% of the whole thing.
Almost 3%. The combined value of their crypto holdings, when you factor in their cash, is about $13.2 billion. That's where the valuation comes from.
So when you buy BMNR stock, you're not really buying a mining company.
Not primarily, no. You are essentially buying a pure asset play leveraged to the second largest cryptocurrency by market cap. It's a proxy for ETH.
But it's not just a passive holding, is it? It's not like they just bought it and are sitting on it.
That's a great point. No, it's not. This massive position gives them preferential trading terms and, more importantly, influence within the ecosystem.
Influence how?
Think about it. Owning nearly 3% of the total supply gives them significant voting power in network governance decisions.
So they get a say in future upgrades and changes to Ethereum.
A strategic seat at the table. They can potentially steer decisions that protect their assets and enhance the network's long-term value. It's an active role.
Okay, and there's another major piece to this treasury, right? The income it generates.
Yes, and this is a key component for their immediate financial stability. A substantial portion, 1.75 million ETH, so exactly half of their holdings, is staked.
And for anyone who doesn't know, staking basically means locking up your coins to help secure the network in exchange for rewards.
Precisely. So let's talk numbers on this passive income. At a pretty modest 3.5% annual yield, this generates an estimated $220 million in passive income annually.
$220 million a year.
And that's not a speculative figure. That's a highly significant, sustainable revenue stream that's completely independent of their mining costs.
So it's a buffer, a hedge against the volatility of the mining business.
It's their foundational layer of stability. It provides cash flow to mitigate, though not eliminate, their operational losses. And we will definitely drill down into those losses later.
And what about their future plans? Are they done accumulating?
Not even close. Their stated goal tells you everything about their ambition. Management has set an aggressive target to acquire 5% of all ETH in circulation.
5%? Wow.
Yeah, it shows this is an aggressive asset accumulation strategy. They are transforming BMNR from a traditional mining orbit into something more like a digital asset holding and infrastructure company.
An aggressive strategy like that needs some serious credibility behind it. Who is steering the ship?
This is another one of their strengths. BMNR has secured some substantial Wall Street bona fides.
Okay.
The chairman is Tom Lee.
The Tom Lee from Fundstrat.
The very same. Co-founder of Fundstrat Global Advisors. He brings enormous Wall Street credibility and, deep market expertise. We're talking over 30 years of experience and a documented track record of some pretty accurate crypto predictions.
So his presence alone lends a lot of weight to their strategy, especially the decision to go all in on Ethereum.
It absolutely does. It reassures institutional investors, and his confidence is exceptionally high. He predicted Ethereum could reach $15,000 by the end of 2025.
15,000?
He later adjusted that slightly to 12,000 by January 2026, but still, that sets a very high bar for the bull case.
So his conviction really reflects the company's entire treasury strategy.
It is the company strategy. When your SERM is valued at $15 billion, based almost entirely on an asset holding, having a recognized authoritative voice like Tom Lee driving that strategy is a massive factor for investor confidence. It's a bridge from Wall Street to crypto.
Okay, so we've established the first pillar of this company is that colossal ETH treasury. But you said there were two pillars.
That's right. If the ETH treasury is the raw upside and the reason for the current valuation, the technology is the defensive moat and the future optionality.
This is where we get into the immersion technologies part of their name.
Exactly. Let's shift our focus to that second pillar because it's what could position them for growth even outside of a crypto bull market. We're talking about their proprietary immersion cooling technology.
And this is a key differentiator for them in an industry where efficiency is everything.
It's the dominant competitive advantage now. In the world of mining and data centers, energy costs dictate your profitability, and heat dictates the longevity of your equipment.
So let's break that down for the investor. Compare this immersion cooling to the traditional air cooling that most places use.
Sure. Traditional air cooling, the industry standard, is basically using massive fans and ventilation to blow air across computer hardware. It's limited, it's loud, and it's inefficient.
Okay.
BMNR's system, on the other hand, submerges the hardware, actual computer chips, directly into a special dielectric fluid.
A non-conductive fluid.
Correct. And that fluid is far, far more efficient at transferring heat than air is. The results aren't just incremental improvements, they're substantial and quantifiable.
So what are the actual numbers? How much better is it?
First, energy savings. The technology offers a massive 20 to 30% reduction in energy consumption compared to air cooling.
20 to 30%. In a business that's all about power costs, that's huge.
It's transformational. It translates directly to lower operational costs and, in theory, improved profitability whenever they actually manage to achieve that.
We'll get to that. What's the second big advantage?
Hardware longevity. It drastically extends the life of their very expensive computing hardware. Immersion cooling can extend equipment lifespan by an impressive 30 to 50%.
How does it do that?
It's because of the superior constant heat dissipation. It eliminates the brutal thermal stress cycles, the heating up and cooling down that air cooling puts on the components. That means less capital expenditure over time, low depreciation costs.
And this tech isn't just about their own mining operations, is it?
No, and that's the key. The immersion cooling market itself is projected to grow from about $570 million in 2025 to $2.6 billion by 2032.
That's a huge growth rate.
It's a 24.2% compound annual growth rate. This places Bitmine right in the center of a fast-growing tech vertical. It fundamentally shifts them from being just a crypto play to a sophisticated technology infrastructure play.
And this is where the story gets really interesting, I think. This technology gives them a ticket into a much, much bigger market.
This is where the growth thesis gets really exciting and provides that crucial optionality, especially for investors who are looking beyond just the ETH price. This is their golden ticket into the trillion-dollar AI infrastructure market.
Because AI generates a ton of heat.
A ridiculous amount of heat. AI workloads, especially training large language models, generate 5 to 10 times the heat density of conventional server applications.
So old school air-cooled data centers just can't handle it.
They can't, not efficiently or cost-effectively.
Mm.
This AI compute boom requires a shift to liquid cooling, which makes BMNR's existing infrastructure and expertise immediately valuable. They aren't just using it to mine, they are positioned to sell this capability.
There's a broader industry trend here too, isn't there? About miners pivoting to AI.
There is a significant one. About 20% of existing Bitcoin miner power capacity is expected to pivot to AI compute by the end of 2027.
And Bitmine is basically a first mover in that pivot.
A rapid first mover. They are leveraging their expensive existing power infrastructure to capture a share of this explosive new demand. They aren't building from scratch, they're repurposing.
The numbers for the data center market are just eye-watering.
They are immense. McKinsey projects that data centers will need $6.7 trillion in investment globally by 2030 just to keep up with demand.
And that demand is doubling, what, every 6 months?
Every 6 months. So BMNR is trying to capture a piece of that massive capital flow. This pivot provides a vital non-crypto revenue stream in the years ahead, potentially giving them the profitability that the company currently lacks.
So while the ETH holdings dominate the balance sheet, their actual income is coming from a few different places.
Yes, and I view that as a protective, diversifying measure. It stops them from being a pure, volatile crypto play.
What are those streams?
Well, you have their self-mining operations for Bitcoin and others, then third-party hosting, where they offer their data center services to clients. They also do mining equipment sales.
And of course, the staking rewards.
And of course, the guaranteed ETH staking rewards. That crucial $220 million in passive annual revenue.
With the future stream being the AI data center services.
Which is potentially the most profitable long-term engine. And look, this diversification is already showing up on the top line. Their revenue grew from just $650,000 in 2023 to over $3.3 million in 2024.
That's a massive jump.
It's a 413% year-over-year increase. It shows they can execute on revenue growth, even if profitability remains the major hurdle we now have to confront.
Okay, and this is where we have to shift gears. As a serious investor, you can't ignore the other side of this, the harsh financial realities. This is the counterpoint to the bull case.
Absolutely. This is where diligence is paramount. Let's start with the biggest red flag: persistent unprofitability.
Despite that explosive revenue growth and the multi-billion-dollar asset base, they aren't making money.
They are losing a lot of money. The trailing 12-month revenue, as of May 31st, 2025, was only $5.45 million.
Okay.
Yet the trailing 12-month net loss was a staggering $6.53 million.
So they spent more than they brought in from operations?
Significantly more.
Yeah.
Their earnings per share was negative $3.03.
But let's look at the margin problem. That's the really stark number.
It is. The company's profit margin is a devastating negative 65.44%.
Let's unpack that. What does that mean in simple terms?
It means that, on average, BMNR loses about 65 cents for every single dollar of revenue it generates from its operations, from the mining, the hosting, the equipment sales.
That's completely unsustainable.
It's a structurally broken model that requires drastic change, either through massive scale in that AI pivot or severe cost reductions.
Now, some people might be confused. They'll say, wait, if they earn $220 million passively from staking, how is their net loss $6.5 million?
That's a crucial distinction. The operational loss is separate from the balance sheet gains on their Ethereum. The company's operations are deeply unprofitable. The staking income provides essential cash flow, yes, but they are still burning capital when you consider depreciation, admin costs, and so on.
And what about their other efficiency metrics, return on equity, return on assets?
It's just as bad. I see extremely poor efficiency there. Return on equity, or ROE, is a brutal negative 95%. Return on assets is negative 14%.
These are textbook red flags. It means they're destroying shareholder value with the capital they have.
Precisely. It indicates very poor asset productivity. Which brings us back to that valuation. You, the investor, must recognize the extreme premium you are paying here.
The price-to-sales ratio is high, around 17, but that's not the crazy number.
No, the crazy number is the price-to-book ratio. It is an astonishing 4,070.
4,000. For context, a typical tech company might have a PB of 5 or 10.
Exactly. A PB of 4,000 means the market is pricing in absolutely zero value to their current operational performance. You were betting purely on two things: massive future Ethereum price gains and the theoretical success of that AI data center pivot. You are paying for pure potential.
Okay, let's move to what I think is the single biggest risk. The one that keeps me up at night if I'm an investor here.
The concentration risk.
Concentration risk.
It is, in my professional opinion, the largest and most immediate risk to the entire investment thesis.
Break down the assets for us again.
Over 98.5% of the company's total crypto value is tied to Ethereum.
98.5%. And what about cash?
Minimal. Cash reserves are only about $398 million, or about 3% of their total assets.
So the stock price is just a leveraged bet on ETH. The correlation must be almost perfect.
It's essentially 1-to-1. Any major drop in Ethereum's price will directly and severely devastate BMNR's valuation and, more importantly, its financial stability.
And we've seen how volatile Ethereum can be.
We have. I remind investors, the 2022 bear market saw an 80% drawdown from peak prices. A similar event today would wipe out over $9 billion of their asset value overnight.
In that kind of prolonged bear market, what happens?
They'd face severe difficulty raising capital, given their unprofitable operations. They could potentially be forced to liquidate ETH holdings at depressed prices just to cover costs. It's the definition of an existential risk for this business model.
Okay, so massive concentration risk. What about the operational side? You mentioned the 7 employees.
Yes, the execution and dilution concerns. I am significantly concerned about their capacity to execute on their very ambitious vision.
Just 7 full-time employees managing a $15 billion company with plans to scale complex AI data center operations.
It raises serious fundamental questions. How do they handle global regulatory compliance? How do they secure partnerships with major AI players? How do they penetrate that hyper-competitive market?
Their dependence on third parties must be huge.
Extraordinarily high, which introduces a whole other layer of operational risk. And then there's the dilution.
Right. They've had to issue a lot of stock to buy all that ETH.
Consistently. That's how they built the treasury. This included a $250 million private placement in July 2025 and a pretty jarring 1-for-20 reverse stock split.
So existing shareholders have seen their ownership percentage shrink.
Significantly. And given the negative cash flow, you have to be vigilant about future dilution. They will need more capital for hardware upgrades and operational expenses.
So we have internal financial and operational risks. What about threats from the outside?
The external threats are just as significant, especially on the regulatory front. This is another potential existential threat.
The shifting legal landscape for crypto.
Exactly. The uncertainty around the SEC classifying Ethereum as a security is a major overhang.
And that would directly impact their staking operations, wouldn't it?
It's a direct threat to that $220 million in passive revenue.
Yeah.
If staking as a service is deemed a securities offering, it could trigger massive compliance costs, potential fines. It could jeopardize their ability to generate that yield.
And it's not just the SEC. There's scrutiny at the state and global level on mining itself.
Yes. We've seen jurisdictions like Laos planning to halt all crypto mining. Domestically, states like New York are proposing excise taxes on mining based on energy use,
Which would eat directly into the efficiency gains they get from their immersion cooling.
It undermines it completely. And then there's the simple lack of clear tax guidance on staking rewards, which just introduces more accounting and compliance risk.
What about competition? Their strategy seems unique now, but is it replicable?
Fundamentally, yes. And that creates pressure from two sides. On the treasury side, you have the success of companies like MicroStrategy with Bitcoin. That could inspire better capitalized firms or even large financial institutions to pursue a similar Ethereum accumulation strategy.
And they could potentially do it faster than BMNR.
Exactly, eroding their largest holder status and their governance influence. Then on the technology front, you have the constant arms race of technological obsolescence.
The computer chips just keep getting better.
The ASICs, the specialized chips, they improve in efficiency by a staggering 30 to 50% every single year.
So to keep their edge, BMNR has to constantly be spending
A massive amount of capital. Conservatively, $50 to $100 million a year just for fleet updates. If they fall behind, their efficiency gains from the cooling tech are nullified. They have to run just to stand still.
And finally, we can't ignore the big picture, the macroeconomic environment.
Never. Higher interest rates globally made non-yielding assets like crypto less appealing. When you can get 5% from a treasury bond, the risk calculation changes.
And general economic uncertainty usually pushes people away from volatile assets.
It does. Plus, a strong U.S. dollar typically correlates with weaker crypto performance. These are all persistent headwinds for their asset valuation.
Okay, we've laid out a pretty daunting list of risks and weaknesses, but despite all of that, the potential reward here is what makes this so compelling.
It is the definition of a high-risk, high-reward proposition. The sheer scale of the potential reward is what draws investors in.
And the primary driver of that reward remains the same.
It is the price of Ethereum. The investment in BMNR is, at its core, a long-term leveraged call option on the price of ETH. If the price of ETH stalls, this stock will struggle, period.
So let's look at the bull case. What happens if Tom Lee's bold predictions come true?
Okay, let's run the numbers. If Ethereum hits his updated, ambitious target of $12,000,
$12,000.
Bitmine's holdings value would surge to an astounding $42 billion.
$42 billion.
This implies a market cap of around $36 billion and a theoretical stock price of roughly $129.
Which is a massive gain from current levels, a potential 150% upside.
A huge upside. And even a more conservative base case, say ETH gets to $5,000, that pushes the implied stock price to around $54, which provides a stable floor for their asset value.
And there are real network catalysts that could drive that appreciation, right? It's not just hope.
No, the fundamental drivers are strong. Institutional adoption through ETH ETFs. Layer 2 scaling solutions making the network cheaper and faster. And the expansion of tokenization, putting real-world assets on the blockchain. These are monumental drivers.
Then there's the second opportunity, which is that AI data center transformation.
And this is so crucial because it provides that optionality. It's the key to decoupling BMNR's valuation from being just a pure crypto treasury.
Their immersion cooling IP is perfectly positioned for this AI compute boom.
Perfectly. By being a first mover, they are trying to capture a share of that projected $6.7 trillion data center investment. Their tech is optimized for the high heat density of AI, giving them a real physical advantage over legacy facilities.
If they can pull that off, they could actually achieve high-margin, profitable revenue.
That's the dream. That's what stabilizes the entire enterprise. And that unique combination, being a huge ETH holder with specialized infrastructure, gives them leverage.
Leverage for what?
For strategic partnerships. They could license their cooling tech to major AI cloud providers. They could do joint ventures with traditional data center operators. Their scale gives them negotiating power that a tiny startup with $5 million in revenue would never possess.
And finally, they have started to get some real institutional validation, haven't they?
They have, which is a big deal.
Yeah.
B. Riley Securities initiated coverage with a buy rating and a hefty $90 price target back in October.
That suggests a huge upside from the price at the time.
127%. That kind of analyst coverage signals growing institutional acceptance of their aggressive asset-backed model. And the NYSE American listing itself enhances their credibility and makes it easier for large funds to invest.
Okay, so let's bring it all together. What are the final thoughts for an investor looking at BMNR?
My final thoughts are clear. Bitmine Immersion Technologies is one of the purest, most leveraged ways to gain exposure to Ethereum's future in the equity markets. It is a classic, high-risk, high-reward proposition that demands intense scrutiny.
So you're essentially betting on three things happening all at once.
Three critical interconnected factors. One, Ethereum's price performance. Since 98.5% of their assets are ETH, this is the primary determinant, the stock is a proxy for ETH.
Two, management's ability to finally achieve profitability.
Which they have not yet demonstrated. The current operational margins are unsustainable. They have to transition to profitable revenue growth.
And three, the successful execution of that AI data center pivot.
That's the key to decoupling from crypto volatility and generating real, sustainable infrastructure revenue.
So given the extreme risks, how should an investor think about allocation?
I would urge conservative investors to cap their allocation at 0 to 2% of their portfolio. Even for aggressive investors, I'd consider 5 to 10% as an absolute maximum. This is a speculative allocation. It belongs in the moonshot portion of your portfolio.
And what are the key metrics you need to watch every single quarter?
You must monitor ETH holdings, cash reserves, and net loss religiously. I would pay particular attention to that cash position. Right now, it's about $398 million.
What's the danger zone?
If that cash reserve dips below the $200 million threshold, the company faces a severe strategic crisis. Do they liquidate their core ETH treasury, sacrificing the bull case? Or do they engage in more highly dilutive equity offerings? It's a high-stress decision point.
And watch that net loss.
Religiously. If it starts to consistently exceed $1 million per quarter, even with the staking revenue, it shows the operational hemorrhage is getting worse.
So it's a calculated bet on the future of Ethereum and next-gen data centers.
But one that requires immense diligence and a deep, deep tolerance for volatility.
Thank you for listening. Subscribe to deepresearchglobal.com for more latest business news briefs, company analysis, and investment insights.